This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, let's talk some charts. Listeners, you're going to find a download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jesse's picture saying, looking for the downloads. All right, Eric, starting on page 2, I have that chart on crude oil. What are you thinking here?
EIA inventory data was delayed this week by the holiday, so we don't have it for you. But the big news this week was Saudi Arabia and Russia extending their production cuts 3 more months. The strong message here is they're not satisfied even at $90 crude. Every dip has been shallower than expected, and the trend is very strongly up. There could still be another shoe left to drop in the form of a recession, further weakening demand. But aside from that, all indications are that the bull market is on in crude.
Yeah, Eric, I know you were looking for that 77 dip on the downside, but the entire consolidation oil did in August was a classic retracement of a bull advance, and it bullishly broke out, and this truly followed through. And like you were saying, the news coming from Saudi Arabia and Russia gave that extra fuel for this breakout. At this stage, I think that the realistic upside targets remain in the mid-90s with some retracement zones that are all the way up at 100. And while it may take a while for us to see a really robust bull market in oil start, I think some more upside here is certainly possible. On page 3, I have that S&P futures chart, and the S&P 500 came to a pretty critical level near this 4,500 level, where it was really, in my mind, a break it or make it moment for the bulls to see whether or not they can go and retest those 2021-22 highs up near 4,800. For me, this is going to continue to be a key pivot area. Market breadth continues to deteriorate. Only a few FANG stocks are holding up. A lot of things are starting to roll over. We're going to watch very closely if the S&P, for whatever reasons, breaks down below this 44.5 level with momentum and challenges those lows from a couple weeks ago. That could really spark a distribution cycle that could do a retracement all the way back towards 4,200. Now, will that be the big bear decline? I don't think so. I think that this simply could just be a deeper, longer correction, but it would start to increase the likelihood that we've already seen the highs of the year. Now, that's not yet confirmed, but this is why we're at such an important juncture in the markets. We're going to see whether or not that technical breakdown actually happens. Moving on to page 4, we have that dollar index. What are you thinking here of the dollar?
We have a breakout in process above 104, which is incredibly significant if it's confirmed, because 104 has been a key level in this market for the last several years. But we need to see the Dixie stay above 104 for a few days to confirm the breakout that appears to be in process as we're going to press. Assuming that it's confirmed, this brings Brent Johnson's forecast of a retest of the recent highs at 115 into question.
Yeah, 104 is generally important, but earlier in the year, we were testing levels just north of 105. So to me, this is not yet a clearing of all bullish ahead here. I still think that there's some overhead resistance that can certainly cause the dollar to bump its head. But I think what is the most noteworthy part is when you break it down to the components. The chart on the euro looks incredibly weak. You see deterioration in the pound. The US dollar yen continues to break out. The US dollar against the renminbi is moving. The Canadian dollar is weak. The Australian dollar is breaking down. There literally is no currency that is fighting this trend now. And so this creates a backdrop where, if the US dollar can hold in here and the bulls are accumulating a breakout above these resistance levels could really drive a move. And usually in a period where the US dollar is strong, it often triggers risk off periods in risk assets. And so the question here is this dollar going to signal something in the coming weeks and months going into the fourth quarter? It's certainly something that's on my mind. Nonetheless, on page 5, I just wanted to touch on that uranium chart. This is the Sprott Physical Uranium Trust. It has broken its 2022 highs, while the U308 contract has not. I think that's largely because this is priced in Canadian dollars, and it's probably some currency factors that to normalize it. But the point here is uranium does look very bullish and continues to be the strongest commodity market out there. So it'll be interesting to see whether this can continue. So moving on to page 6, we have gold. What are you thinking here, Eric?
Gold is rolling over here predictably as the dollar strengthens. My outlook is for inflation to persist and for the Fed to continue hiking rates longer than most people can believe possible. During that phase, there's no real reason to expect new all-time highs, and I won't be surprised if the market drifts considerably farther lower from here. But eventually, the Fed will break something and be forced to cut rates as inflation continues to run rampant. And that's when gold will really shine. The ride from 2100 to 2500 is likely to be a short one, but the ride from here to 2100 will probably take longer. For now, I think gold will continue to muddle along until there's a clear change of Fed policy, and I don't think that's going to come until 2024.
Yeah, gold remains in consolidation. I am in the camp where inevitably gold will have a break to an all-time new high and drive a trend higher. I'll agree with that, but I honestly think that it's very reasonable to assume that that won't happen until we have entered some sort of monetary easing cycle. And so it's possible that risk assets generally will do poor for a certain period of time, which will put pressure on gold to stay, trade range bound, or even have a couple liquidity events to the downside. I think almost all opportunities on any dips on gold, I would be a buyer. But I think that if you're waiting for a big gold breakout, it is going to be either late fourth quarter or first quarter. I think there has to be patience here for investors that are pressing this trade. The last thing I wanted to just touch on is the high yield bond market. This is the chart of HYG on page 7. And what's interesting is that in spite of treasury bonds having a very ugly period, surprisingly, high-yield bonds were not impacted. They were trade range bound. This caused credit spreads to narrow to 4% area. So the high-yield bond market has not yet cracked, and it's certainly not sending any warning signs. But I think increasingly, this is the place to watch because you hear all sorts of people warning that there's credit risks out there. I think that the junk bond market is going to be the one that will advertise it. And while maybe you don't need to directly trade it, it certainly can be used as a canary in a coal mine to see when things have actually pivoted. So we're going to be watching when these break down and when we, let's say, have high yield credit spreads start clearing 5% on the upside. All these types of things will, in my mind, really signal that some things are turning.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.